Somewhere in your bank statement this month is a line item you probably scrolled past, a monthly maintenance fee. Maybe $12, maybe $15, maybe $25 if you didn't keep a high enough balance. It landed the way it always does, quietly, automatically, with the low-grade familiarity of a charge you stopped questioning sometime around the second or third year you paid it. Here is what that fee replaced. In 2009, 76% of checking accounts at large American banks were free. No minimum balance, no monthly charge. Free, as in the bank wanted your business badly enough to compete for it. By 2012, 3 years later, same banks, same customers, that number had fallen below 38%. The accounts didn't change. The banks didn't change. What changed was the competitive landscape those banks operated in. And understanding how that landscape changed and who changed it and what it has cost the average American depositor in the years since requires going back to a specific season when the American financial system was on fire, and the people who put it out decided to let a few institutions hold the hose. September 2008. You know the broad outline. Lehman Brothers collapses, Congress debates, $700 billion gets authorized under the Troubled Asset Relief Program. The official story is a rescue, the government stepping in to prevent the collapse of the financial system and protect ordinary Americans from something worse. All of that is true as far as it goes. What the official story leaves out is what happened to the competitive structure of American banking while the rescue was underway. Because the 2008 crisis was not just a collapse. It was, for the institutions that survived it, the greatest consolidation opportunity in the history of American retail banking, and they used it. J.P. Morgan Chase moved first. In March 2008, Bear Stearns, one of the oldest investment banks on Wall Street, was acquired by J.P. Morgan for what amounted to $10 a share. The Federal Reserve provided a $29 billion backstop against Bear's troubled assets. J.P. Morgan got the firm, the public absorbed the risk. 6 months later, J.P. Morgan did it again. Washington Mutual, the largest savings and loan institution in the United States, with $307 billion in assets, failed in September 2008, the largest bank failure in American history. J.P. Morgan acquired it for $1.9 billion. Not a typo, $1.9 billion for $307 billion in assets. The Federal Deposit Insurance Corporation facilitated the transaction. Wells Fargo acquired Wachovia in December 2008 for $12.7 billion. Bank of America had already absorbed Countrywide Financial, the subprime lending machine that had done more than almost any institution to cause the crisis, in January of that year, and followed it by acquiring Merrill Lynch in January 2009. Think about what this looks like from a competitive standpoint. Imagine a neighborhood with 4 hardware stores. One of them catches fire. While the fire department is still on scene, the other 3 buy the burning building, the inventory, the parking lot, and the customer list with the fire department's credit card. The neighborhood still has hardware stores, there are just fewer of them now, and they don't need to compete with each other quite as hard as they used to. This is what the bailout built. The 5 largest American banks controlled roughly 35% of total U.S. banking assets in 2000. By 2010, that figure was approaching 45%. The number of FDIC-insured commercial banks in the United States stood at approximately 7,000 in 2008. By 2023, that number was under 4,200. 40% of the American banking landscape gone. Not from failure mostly, from acquisition, from consolidation, from a crisis that the largest institutions survived by absorbing the ones that didn't. The word for what this produces in any industry is pricing power. And pricing power, when the product is a checking account, comes out of your pocket. When there are 4 gas stations on the same corner, the price stays honest. When one company buys 3 of them, the price goes where it wants. This is not a conspiracy, it is arithmetic. Competition constrains pricing. Remove the competition, and the constraint goes with it. The banks had a ready explanation for what happened to free checking. In 2010, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. Buried inside it was something called the Durbin Amendment, which capped the fee that large banks could charge retailers every time a customer swiped a debit card. Before the cap, the banks collected an average of 44 cents per transaction in what's called interchange revenue. After the cap, the maximum for large banks dropped to roughly 21 cents. Across billions of transactions annually, the industry lost an estimated $8 to $9 billion in interchange revenue. The bank said, straightforwardly, that free checking had been subsidized by that interchange income, and that without it, free checking wasn't economically viable. That explanation is not entirely wrong. The revenue hit was real. The connection between interchange income and free checking was real. The banks were not lying about the math. They were, however, making a choice, and they were making it from a position of unusual comfort. The same institutions that eliminated free checking to offset the Durbin Amendment's impact were the same institutions that had just spent 2 years acquiring their largest competitors at crisis prices, with federal guarantees absorbing the downside risk. They were operating in a less competitive market than they had operated in before. They could afford to charge for checking because, in most American communities, there was no longer a competing institution down the street offering free accounts to take their customers. The math on what this costs is not dramatic on any individual line. $12 a month is $144 a year. For a family maintaining 2 accounts across 20 years, that's nearly $6,000 in fees on accounts that were free when those same banks were asking for a rescue. It compounds quietly. That is precisely how it was designed to work. Here is a number: 0.01%. That is the average annual percentage yield on a savings account at a major American bank for most of the decade following the 2008 crisis. On $10,000, that is $1 per year. $1 in interest on $10,000 in savings, while the bank lent that money out at rates between 4 and 24%, depending on the product. The Federal Reserve lowered its benchmark interest rate to essentially zero in late 2008 and held it there until December 2015. It returned to near zero in March 2020 and stayed there until March 2022. Banks borrowed cheaply from the Fed and lent at market rates. The spread between those two numbers was the profit. Depositors, who provided the raw material for that spread, received the 0.01% and were invited to feel grateful their money was federally insured. Then something changed. Beginning in March 2022, the Federal Reserve raised rates aggressively, one of the fastest hiking cycles in American history, taking the benchmark rate from near zero to 5.25% by mid-2023. Rates hadn't been this high since before the crisis. Watch what the banks did. Mortgage rates rose almost immediately. Credit card rates rose almost immediately. Auto loan rates rose almost immediately. The borrowing side of the ledger repriced within weeks. The savings side of the ledger repriced on a different schedule entirely. Average savings rates at major banks remained well below 1%, well into a rate environment where the Federal Reserve's own benchmark exceeded 4%. The banks were paying depositors 0.4% to hold money they could park at the Federal Reserve itself for 5%. The spread had never been wider. The profits had never been larger. J.P. Morgan Chase reported net income of $37.7 billion in 2022. In 2023, it reported $49.6 billion, the most profitable year in the bank's history. Not its most profitable year since the crisis, its most profitable year ever. The year that savings accounts at the nation's largest bank averaged somewhere between 0.01 and a few tenths of a percent. This is not accidental. It is the predictable behavior of an institution with significant pricing power over its depositors. You could move your money to a high-yield savings account at an online bank and earn 4%. Most people don't, not because they don't know, but because switching banks is friction, and the big banks know that friction is worth billions of dollars a year in suppressed rates. The gap between what you earned on your savings account and what the market was offering was a deliberate product of the consolidation that made it possible to let that gap exist. Someone buys lunch. A sandwich, a drink, maybe a bag of chips. $22. Their account has 19. The transaction clears. The fee? $35. The bank has just charged $35 to cover a $3 shortfall. If you calculated the annualized interest rate on that $3 loan, it would run somewhere north of 400%, which would make a payday lender uncomfortable. This is not an edge case. This is, for more than a decade after the financial crisis, one of the most reliable revenue streams in American retail banking. At the peak of the post-crisis overdraft economy, American banks were collecting somewhere between $11 and $15 billion annually in overdraft and non-sufficient funds fees. The Consumer Financial Protection Bureau, the agency created specifically to track this kind of thing, which we will come back to, studied the overdraft market extensively. What they found was not a product being used broadly across the customer base. It was a tax falling almost entirely on a specific population. 8% of account holders paid 75% of all overdraft fees. Not a typo. 8% paying 3/4 of the total. Those 8% were disproportionately younger, lower income, and living close enough to the edge of their accounts that a $35 fee wasn't just an inconvenience, it was a cascade. One overdraft triggering a low balance, triggering another overdraft, triggering another fee. The CFPB documented consumers paying hundreds of dollars a year in fees on transactions that averaged under $25. In 2010, the Federal Reserve required banks to get customers to actively opt in to overdraft coverage on debit and ATM transactions rather than enrolling them automatically. The regulation was real. The response to it was instructive. Banks launched aggressive marketing campaigns to drive opt-in rates. Some used pre-checked boxes in digital enrollment flows. Some presented overdraft coverage as a benefit rather than a product, because the $35 fee wasn't a bug in the overdraft system. It was the system. Wells Fargo is worth a moment here. The same institution collecting billions in overdraft fees during this period was simultaneously running an internal sales program that had led employees to open approximately 3.5 million unauthorized customer accounts, fake accounts, in the account's owners' names without their knowledge or consent. The scheme was designed to hit internal sales targets. It was surfaced publicly in 2016. Wells Fargo paid an initial settlement of $185 million, followed by a $3 billion settlement in 2020. The employees who opened the accounts were fired. The executives who designed and enforced the sales quotas that made the fraud structurally inevitable were not criminally charged. The overdraft fee and the fake account scandal are not the same story, but they share a logic. When the competitive pressure that would have punished this behavior, customers leaving for a better institution down the street, has been systematically reduced, the behavior becomes rational. Not defensible, rational. At its post-crisis peak, the United States had approximately 99,000 bank branches. By 2022, that number was approximately 72,000. 27,000 locations closed in 13 years. Branch closures are, on their face, a reasonable response to digital banking. Why maintain a physical location when most transactions happen on a phone? That argument is coherent up to the point where you ask which branches closed and where. The closures were not distributed evenly. Federal Reserve research, National Community Reinvestment Coalition reports, and FDIC data all point to the same pattern. Branch closures were disproportionately concentrated in lower-income communities, rural communities, and majority-minority communities. The neighborhoods where branch-level banking mattered most, where residents were less likely to have reliable internet access, less likely to qualify for the digital products that replaced branch services, and more likely to need in-person assistance navigating basic financial products, were the neighborhoods that lost branches at the highest rates. The FDIC counted approximately 5.9 million unbanked American households as of 2021. Unbanked, meaning no checking account, no savings account, no relationship with a federally insured financial institution. Those households are disproportionately Black, Hispanic, and low income. Their alternative to a bank branch is a check cashing service that charges between 1 and 3% of the check's face value. On a $1,000 paycheck, that is $10 to $30 every 2 weeks, every year. $1,000 or more annually to access money that was already earned. The communities hardest hit by the foreclosure crisis that preceded the bailout, the neighborhoods where subprime lending was most heavily concentrated, where home values collapsed most completely, where the economic damage of 2008 and 2009 was most directly felt, are the same communities from which the branch network quietly retreated in the years that followed. The rescue did not reach them. The restructuring did. Bank of America, 2014, $16.65 billion, largest civil settlement with a single entity in U.S. history at the time. The Department of Justice announced it with language about accountability, about consequences, about the importance of holding institutions responsible for the conduct that contributed to the financial crisis. J.P. Morgan Chase, 2013, $13 billion. Similar language, similar announcement. Combined with other major bank settlements, the crisis-era accountability tab ran into the tens of billions. These were real numbers, real money. And then you look at what they actually represented. Portions of the settlements were structured in ways that allowed banks to claim tax deductions, reducing the effective cost to shareholders. The institutions that paid them continued operating, continued growing, continued posting record profits. And the standard against which any settlement's deterrent value should be measured is simple. Is the fine larger than the profit generated by the conduct it punishes? In case after case, the answer was no. When the penalty is smaller than the revenue, it is not a deterrent. It is a licensing fee, the cost of doing business built into the model from the start. No senior executive at a systemically important American financial institution was criminally convicted for conduct related to the 2008 financial crisis. This is documented fact, not allegation. The Department of Justice made prosecutorial decisions, some of which were later discussed publicly by officials involved. The result is the public record. The Consumer Financial Protection Bureau was created by Dodd-Frank specifically to address the consumer-facing dimension of what this video has documented: the fees, the overdrafts, the suppressed rates, the deceptive enrollment practices. In its first decade, it returned approximately $17.5 billion to consumers through enforcement actions and supervisory work. It also became, almost immediately, one of the most legally and politically contested federal agencies in American history. The institutions it was created to regulate spend millions lobbying to limit its authority, challenge its funding structure, and constrain its enforcement capacity. That effort has never fully stopped. Come back to the monthly maintenance fee. The $12, $15, $25. The charge that lands in the statement and gets scrolled past. That fee is not a mistake. It is not an oversight. It is not the unintended consequence of a regulatory regime that tried its best. It is the predictable output of a financial industry that emerged from the 2008 crisis with fewer competitors, more pricing power, a documented history of conduct that cost tens of billions in settlements and zero in criminal convictions, and a regulatory environment that was contested at every step by the institutions it was meant to govern. The banks are not villains in a simple story. They're institutions operating rationally within a structure that rewards exactly what they are doing. The surprise would be if they did anything different. Before the 2008 crisis, J.P. Morgan Chase reported net income of approximately $15.4 billion. In 2023, it reported $49.6 billion. The institution that absorbed Washington Mutual, Bear Stearns, and more recently First Republic, three of the largest bank failures in American history, each acquired with federal assistance at crisis prices, is now more than 3 times as profitable as it was before the crisis it was rescued from. The paper trail on all of this is public. The FDIC publishes it, the CFPB publishes it, the banks publish it themselves in quarterly earnings reports, in footnotes, in disclosures nobody reads. The documented record of who got bigger, who got richer, who paid fines and kept going, who lost branches and kept fees, and suppressed savings rates through two separate zero-rate environments, it has always been there for anyone who wanted to look. The system that built this is still operating. It processed your direct deposit this morning. It will charge you next month for the privilege.